This is the MBK Beat with Mark Kashevsky from MBK and Associates, Inc. Your place for finding all you need to know about life insurance and how you can get more out of your money. Recorded live here in Buffalo, New York, it's time for the MBK Beat with Mark Kashevsky. Hello, folks. Welcome back. We're here with the MBK Beat with Mark Kashevsky. This is the first episode of the second series. All first 10 of our episodes you can find on YouTube, anywhere you listen to podcasts, where we broke down about 10 different plays of the playbook. And now what we're going to do is we're going to go back into each of them and break them down into a real case study, sort of a John Doe approach, where we're going to look at some real case examples and break it down a little bit more for our viewers out there. So today we're gonna start with the IRA conversion and compare a few things between traditional IRA, Roth IRA, and a better mousetrap, as you noted. So I'll turn it over to the expert Mark Kashevsky to introduce our 11th episode today.
Thank you, Jeremy, and morning, everybody. Today we're going to talk about IRA conversions and options, and what are the issues people facing retirement or getting ready for retirement have to deal with. And to set the stage, what I'd like to say, first of all, is that when, in your earning years, starting in your mid-20s, right up to age 60, 55 or 60, the focus is on making money, making contributions, getting tax deductions, and growing that asset from an investment perspective. So the focus is, contributions, tax savings, and growth. Contributions, tax savings, and growth. But as we approach retirement, and 55 to 60 is when this starts becoming a bigger issue, the focus becomes a little different. What do I mean by that? Well, people start thinking about not making money, they start thinking about income. Retirement income becomes the focus as people approach retirement. And the people want to know, how much money can I take out? And am I going to run out of money? Everybody hears about, am I going to run out of money at retirement? How long will my money last? How much can I take out? How much risk can I handle in retirement? Those become the talking points in people's minds about their retirement accounts. And we've boiled it down to really four basic issues from a priority standpoint. The first is future tax risk on distributions. What am I going? I've got all these tax deductions. Everyone said I'm going to be in a lower tax bracket, but is that going to happen? We'll talk about that a little bit more. What about investment risk? I've been through a couple downturns, a couple market crashes. Most people that suffered through the 2008 market crash took 5 to, in some cases, 10 years to get back to where they were in 2008. I can't afford that when I'm retired. How long am I going to live? People say, gee, I can only take 3 or 4% of my money out. I've got $1 million in my pension account. I can only take out $30,000 or $40,000, and that's before tax. I can't live on that, and I've saved $1 million. And then, will there be anything left for my spouse or for my children? So those are the four issues that people are confronting every day as they get into retirement. Now, we basically have three options as we plan for retirement and how we're going to take our qualified plan or IRA money. We can keep it as keep it as an IRA, basically. If you have a qualified plan or a 401k, when you retire, you can roll it into an IRA and then start taking income. Or you can take that money and convert it to a Roth IRA. And thirdly, we have an indexed universal life alternative to a Roth that we think does a better job. So those are your three options. Now, how do these options help you deal with those four issues? Well, a traditional Roth IRA does not solve any future tax issues. And what do I mean by that? when you go to retire, we don't know what tax rates are going to be. The concern is, especially today, when we've spent $6 trillion, we have $30 trillion of debt, we've printed we now have $19 trillion of money circulating in the banking system. A year and a half ago, it was $2 trillion. Is there going to be inflation? Is there going to be taxes to cover this? How do we pay for our debt? Most people believe taxes long-term are going up. So that's a traditional IRA doesn't solve that problem. You pay your tax as you go. A Roth IRA, oh yes, well, we'll solve the tax problem. Convert it now as you get before retirement. Typically, people, once you get to age 60, you can convert without any tax penalty and start taking distributions. We typically do it over 3 to 5 years. And then you've covered the tax and there's no more tax on your money or your buildup or your income. So, and our option does the same thing. I've got an example we'll walk through. But from a tax risk standpoint, a Roth IRA and our solution solve the problem. A traditional IRA does not. Let's talk about investment risk. Typical IRA and Roth IRA accounts invested in the stock market always have risk. You can manage that risk, you can asset allocate, you can hire an investment advisor, but the bottom line is you're still in the stock market. You still have risk. With our product, you do not have that risk. What about longevity? If I want to take 5% out, how long will it last? If I want to take 10% out, how long will it last? That's an open-ended question. We have a product that will guarantee you an income for life. So we can solve that problem. And finally, will there be anything left for my children, my grandchildren, charity, whatever? We don't know. With a Roth or traditional IRA, with our product, there's always a income tax-free death benefit to somebody, no matter when you die. Let's go through some examples here. I'm going to highlight a few points here, Jeremy.
Perfect.
So this is a standard qualified plan, and each one of these have $1 million in them. This is an actual case on a physician, and he had more. He had a substantial amount of money in his pension accounts, and he took a portion of it and converted it to our Roth alternative. Now at age 60, and he just did this within the last year. He converted it, but we showed him these options. He said, if you don't do anything, and you continue to be in this tax bracket, and you continue to earn this kind of money on your investment account, at age 70, how much money can you take out, assuming you continue to earn that 5%, which some people feel is too high, but that's what they wanted us to use. You'll be able to take out roughly $100,000 a year. After tax, that's $60,000 a year. So your net distributions to age 100 would be $1.8 million, and you would have paid about $1.2 million in taxes. All right. Well, let's talk about doing a Roth conversion over the next 5 years. Well, you're still in a 40% bracket, so you're going to pay $400,000 in tax, have $600,000 left, and using the same interest rate and the same tax, the tax bracket doesn't really matter anymore. We can eliminate that because you've already paid your taxes. But now you're going to get just about the same. You're going to get roughly $60,000, but there's no tax on that money. So assuming if taxes stay the same, it doesn't matter what you do. If taxes go up, you're going to have more spendable income with the Roth. And to age 100, the distributions are about the same, but the tax was a lot less. And we have two IUL alternatives. I'm just going to focus on the second one, and I'll explain to you why in a minute. Excuse me. So let's just talk about this, and this is what the doctor did. We took the $1 million, and over 5 years, he took $200,000 a year out, and I'll show you that in the example. And we covered the tax, and I'll show you how we did that. And our illustration, we are able to project 5.67 based on regulations. Our actual performance is much better than that, but we can't show that. And I'm okay with that. But based on that, without any enhancements, using that interest rate in this product, we're able to pay out $108,000, and it's tax-free by law. So the net income is $108,000 versus $60,000. That's a big difference.
Yeah, it certainly would make a difference in lifestyle.
To age 100, it's $3.2 million. And this needs to be corrected. The actual taxes he would have paid here are $400,000. Let's make that correction. I just noticed that. But by the way, there's also an estate benefit at age 100, which you don't have with the Roth or the traditional IRA. $3 million.
And that would be for anyone, essentially family, spouse.
Anybody. Income tax free. So there's a lot more value in our approach, and that's just on the first page. What I want to spend the rest of the time explaining is how can we do this? It's the sounds too good to be true story. I'm going to show you why this is very unique to any other financial product available in the Western world today. And then what are the what is the additional upside that we can't even show in this product? Okay. So this is an actual policy illustration summarized where he's taking the strategies to take a distribution from the IRA, $200,000 a year for 5 years, and he's going to pay that money to the insurance carrier. In this case, it's Pacific Life. There again, we illustrate today based on regulation at 5.67% performance, projected performance, and each year we're going to distribute $80,000 to cover his tax liability. So he makes these annual distributions, and at the end of the year we give him the money to cover his tax. But we want to put this money in the policy, as much money as soon as possible. We can't do it all at once because, first of all, they could skew his taxes to cover this, and two, we have limitations in the tax law called the modified endowment rules that limit how much we can put in here for a given amount of insurance. We're not trying to load up on the insurance. We're trying to put as much cash in the contract with the least amount of insurance the law allows. All right? So that's what's going to happen. And at age 70, we're able to pay this income distribution that goes all the way to actually lifetime income. It goes to 120 actually. And here's the death benefit. Immediately it's $2.8 million. Once we start taking out the money, it goes down. We reduce it as much as possible, but it fluctuates. And life expectancy, it's up to $1.1 million, and at age 92 it's $2 million, and as I said, at age 100 it's over $3 million. All right. How can we do that? How in God's name can a financial product do that? Well, this is the key to the answer. It has to do with something called policy loans, and specifically alternative policy loans. Because we're funding this with a life insurance contract, policy loan distributions are non-taxable. That's why we get tax-free distributions. But up until this product was invented, when someone took a policy loan on a contract, they would get credited 3 or 4% on that money, that they had actually taken out, and then they would be charged 5 or 6%. So it was costing them 2 or 3% to borrow that money. And if people didn't pay that money on top of the distribution for retirement, for example, they just sucked it out of the policy. So it was a real drag on the cash values and risked lapsing the policy, which can't happen here for another reason. But when this product was invented around 1997-98, Pacific Life was the company that invented this product. They structured their policy loans differently. And what you need to understand on all policy loans, when you take a policy loan, you're not borrowing from your policy. Your cash stays in the policy. When you see the surrender value, it nets out the loan because the loan has to be paid at some point. In our example, it's paid at death. And those death benefits I showed assume the loan's been paid, and that's the net death benefit you see. But you're not borrowing on your cash. You're using your cash as collateral and borrowing from the insurance company. So your money is still in the policy, earning whatever interest you're earning. Now, in a whole life policy, it was 2 or 3%. I mean, they were charging you 4 or 5 or 6. Doesn't work that way here. What happens when you start making distributions, whether it's to cover the taxes or it's to start taking out income, the amount of money that you're earning interest on is not the net value after any distributions here or in the future. It's the full accumulated amount because all that money stays here. So the reason we want the money in the policy early and we make a refund to cover the taxes is because we're able to build more accumulation value early. So by the 10th year, instead of having just $500,000 or $600,000 in the account to earn money on, like you would have in a mutual fund Roth, we have $1,102,793. Because we have that, we can pay more income out. That's one of the reasons. So when the illustration projects at this interest rate of 5.67%, what are we going to be able to pay? It comes out to be $108,143, not $60. The loan strategy, because by the way, what's happening in this loan? In this example, we're assuming a net cost of zero loan. The loan provisions in these contracts are vastly different than they were for 100 years in policies. So we don't have a negative drag on distributions. It's either zero or it could be positive. I can't show the positive here, but without the positive, we're able to show $108,143 forever. Because look at what happens in year 30 when you keep adding the value accumulating at 5.67%, and the distributions are coming from the bank, not from the policy. You have a huge account balance. Huge. All right? That's the secret sauce that no other financial product in the world has available to it.
And this is some of the no downside or the no risk.
That's something else.
Got it.
That's something else. This is just the mechanical contractual provision that triggers when you take policy loans to create retirement distributions on a non-taxable basis. It's unique. Nobody thought much about this when the product was invented. It was like the internet. What's the internet in 1996? What's a cell phone? Well, let me tell you, the cell phone and the internet have changed the world. This is changing the financial world. This is how big this is. And that's just the basic contractual provision and how it works. But in addition to that, there are 3 things that provide upside to the client that I can't even show on that illustration by regulation. There are 3 things that provide upside. And when we do take this money out, we are allowed to either create what's known as a wash loan, where you're going to get 2% on the money that you collateralize for the bank loan from the banks inside of the house, and they'll charge you too. So it's a wash. So that's what I'm showing. Or we can implement what's known as an alternative loan strategy, where the carrier's going to charge you 4 or 5%, but you get to keep the money in the index account. Now, we're illustrating 5.67%, but historically, we have averaged, in our basic 1-year account that's been there from day one, we've averaged 7.43%. That's what they call a positive arbitrage. Here's what they've actually earned versus what they charge. it's almost 3% difference in the client's favor. And if we add that to the illustration, if I was to do that, that number would be multiple times higher. Multiple.
The annual,
income.
that 100,000
Oh, yeah,
figure.
we're talking significant increase if you're able to project that average arbitrage over 30 years. It's huge, as Billy Facilla used to say at his dealerships. It's huge. So that's upside. That's the first piece of the upside. That's called the alternative loan strategy. And that's something the client decides if they do or don't want to do. But that's pretty positive. The second is actual performance. The actual performance in the 1-year account has been 7.63%. This is actually up to last month. Okay. And I'm actually in one of these accounts, and I'm in the 1-year high cap. That historical performance has been 9.3%. I can't show that. Okay. We have an unlimited account that's averaged 14.3%. I mean, the only one that hasn't done better than projections is the international. All our other accounts, our index accounts, have outperformed projections. So as opposed to, every whole life policy in the Western world, they show their performance and they project their historical performance. Their actual performance has been less than the projections over the last 15 years.
And that's something we've talked about in the past in some of these older
so
plans.
I'd rather, they show performance and they don't get there. We show projections versus performance, and we're kicking butt with these products, especially with this carrier.
And just for the viewer, when you say like you can't, why? Just touch on that a little bit in terms of like why you can't show that 9 or that 7% because it's fiscally responsibility.
There's an illustration regulation that the National Association of Insurance Commissioners that kind of regulates this nationally, illustrations that doesn't allow carriers. You can only project. They're trying to level the playing field with projections. Mm-hmm. And I get that totally, so I'm comfortable with that. So you have to take your projection, your performance, and back it down by 1.5 or 2%. That's how we get that number I just showed you, based on the account you're showing, the 1-year account in this example. And they don't allow you to show the other contractual enhancements, and that's more of an industry issue because there are a lot of carriers that don't have these enhancements. And they've pretty much ganged up on MidPac Life to kind of tilt the scales, which to me is a quote unquote political manipulation type thing. But the reality is, I know in my contract and my customer's contract, these provisions are in there, and I know they will make a huge difference on top of what we can project.
And what we can project is what we talked about first, and that's the baseline. That's sort of out of the box. That's what we're going to get. But
that I can't guarantee that either. The guaranteed account is 2.5% right now.
Okay, got
so there's a floor.
Okay.
We'll talk about that more in a minute. But, for 20 years, this contract is averaged on the baseline account that's been there, 7.5%. We can only project 5.67. I like, what are we going to do in the future? I'm comfortable with that projection. I think, that we'll get there because there's something else in here that I'll talk about, the fact that you can't lose money, that also helps. But so anyway, we have this loan provision that creates the additional value in the contract because the money never leaves there, and because of the way the loan is structured, you're going to get the 108, or you're going to get more, depending on which loan option you take, because you can't lose on the loan option. You can only it's going to do what we told you it's going to do. It's going to do better if you take the alternative loan and we make money for you. And secondly, we have we're showing substantially lower projection based on what we've actually done, which is the antithesis of what the insurance industry does with their other products. So those are two upsides, okay? The third one is the I call it the multiplier, and it's the ability in the contract to you actually purchase. This is the only out-of-pocket cost or the only downside to the client. And I don't have this example here, but I have a client that had a huge trust policy and a whole life contract that I had sold him many years ago, and it was earning less than 2% cash on cash. They said it was earning 3%, but when he took out the mortality charges, it was 1 point something. And he had $1.2 million of cash value in the policy. I think it was like a $7 or $8 million death benefit. And I told him, John, why don't we do an exchange, your trust to this, and we'll get I'm pretty comfortable we can get you at least 5 or 6%, and we'll probably do better than that. He said, fine. So we did that. He was healthy. He had to qualify for it. Rolled the money in. First year was and his accountant had him go into one of the accounts that is the 1 year uncapped account. So the 1 year account, there is no cap on the index. All right, but in order to be able to buy that option package, the cash they earned on his $1.2 million wasn't enough to justify the uncapped, so they charged the client, and that changes every year. First 2 years he did it, they charged him $60,000 out of his $1.2 million to buy the secondary option. And that year, the S&P went down 40% because of COVID. So his account actually lost $60,000. So what do you want to do? His accountant said, I want to keep it in there because he's going to make it up. So he paid the $60,000 again. And I wish I had brought it with me, but this April, he gets his statement for the year, and he says, he emails it to me, Mark, is this correct? Okay, so the S&P March 2019 to March 2020 went up 66%. So we got to keep 61% of it. Mm-hmm. So his cash value went up $800,000. So he went from $1.2 million to $2 million. But that's not the end of the story. He had this multiplier that he paid that for. And that multiplier added another $1.2 million. $1 million. Okay, so multiplied the 1.2 more than 66%. But I'll keep the calculation in my head. But he made $800,000 on the upside on the index, and on the multiplier he made another 1.2. So his cash value went from 1.2 million to 3.2 million on a life insurance policy in 1 year.
And how long did he have that traditional one before to get to the 1.2?
Well, he had that for 7 or 8 years.
And then in 1 year, basically almost tripled that cash value.
Almost, he did.
Yeah.
Yeah, he did. He just about tripled. And by the way, so that's what this Performance Plus is all about. And, it created an additional return in this example here. In his case, it was huge. But this is the third upside. So you've got performance versus projections. You've got the loan strategy, and then you have this multiplier. And what's interesting is that's all. This is upside down. With the fact that you have a downside floor in this product. If you're in the index now, and if you're in the guaranteed account, there's a minimum interest rate. Now it's 2.5%. But on the indexes, your floor is 0 unless you buy the secondary option. So, when there was, in 2008, when there was a huge correction, people with this contract didn't lose a dime. They didn't lose all this money. And the people in the S&P had to go from 2008 to 2016 until they got even again. And guess where the clients of this product were? They were all the way up here. So in addition to the numbers work to begin with, and you have 3 upsides, you also have a floor, so you can never lose. So we solved the tax risk when we did the conversion. We solved the income risk with the product, income payable for life. We solved the investment risk with the zero floor, and you have all this upside. And oh, by the way, there's going to be money left to your estate. Not bad. I mean, there's so much going on there, it's hard to keep track of. And, these are the caps of the different accounts. And I'm a big, I like the 1 year high cap. That's my wife and I have a couple Roth conversions, and that's what we're in. And because of what happened last year, I'm actually suggesting to my clients that we split it between that and this one. So my wife and I just split 50-50, and I'm advising all my clients to do that. Okay, because if you have a bad year, you got to get to 8 or 10% to get to the no cap. So I said, well, keep half your money and get 8 or 10%. And if you don't get above the 10% or then you're going to at least hit the baseline projection of 5, 6, 7. So there's a little rationale behind it, but that's what we're doing.
And that would be almost a little bit of a safety net to that risk, just kind of balancing that risk a little bit.
Well, I like you don't have to triple your money for this to work. Okay?
Right.
So if you're in the 1 year high cap, if you're getting something above 5 or 6% every year on at least half your money, you're gonna be there. And if every so often you hit a home run, I mean, in this case, the reason we had this trust was so he could start distributing money to his children and grandchildren, and he was going to have to wait 10 or 15 years to do it. And he said, Mark, now that I have $3.2 million in there, when can I start giving money out to my kids? And how much can it be? And I did that. We went back to the home office, ran the numbers. He could start taking, based on a 6% projection, 5 or 6% projection going forward, no more big wins. He could start taking $250,000 out a year now. Okay? So, I mean,
that's with no projections. That's at the 5,
Yeah, that was at whatever we're allowed to project.
Right, that's at the projection.
Because when we put those kinds of numbers and project them in an illustration, we have to use what the regulations tell us to use. So, and I'm comfortable with that. But, he was pretty happy.
Yeah.
And I've got a dozen customers who hit home runs like that. I mean, I had the bonus, and in my wife's and our contract, we made 22%. So, and I'm just trying to get 5 or 6.
Right.
So, this product really does, the conversion strategy takes care of the tax problem to a Roth type product, but with this indexed universal life overfunding, we are eliminating investment risk because of the zero floor, with the exception of the secondary option if you buy it. We are creating lifetime income of a much higher amount because you're not spending the money with us when you take it out. You're collateralizing it, and the money's still there to create income, and it's for lifetime, and it's tax-free, and you have a zero floor. There's no investment risk here, and you have tremendous upside. You don't have a multiplier with a mutual fund. You don't have a alternative loan strategy with the mutual. It's really, there's nothing. I've been doing this for a long time. What kind of bank product, what kind of stock product, investment product, alternative investment. There's nothing close to this, in my opinion. And the company, this company does a great job. When we started these contracts, they only had 3 or 4 accounts. Now they have 8. A lot of carriers, you want the new account, you got to buy the new product. We're going to subsidize it. Oh, we're going to change your cap and lower your cap so we can give the people we're selling to a higher cap. It's a bait and switch technique. It's a dirty secret of a lot of carriers. This company doesn't do any of that. They treat everybody the same. They are the gold standard in customer treatment. They're so well respected, by the way. And by the way, their financials are outstanding across the board. They're in the upper tier of financial ratings. But interestingly enough, Forbes rates every insurance company that sells cash value policies every year. And guess who's number 1? okay? Pacific Life. You want to know why? Because of what I just told you. Because of the story I just laid out. So, do I sound a bit like a zealot or a prophet? Maybe I do, but, I've been doing this for 40 plus years. I've seen the industry and all the products, and I know where the bones are buried, and this company does a great job. And this product takes, the conversion strategy gets rid of the future task risk, but this product absolutely takes care of investment, longevity, and estate risk better than anything I could talk to you about, plus all the upside. So that's my story, Jeremy, and I'm sticking to it.
I appreciate it, Mark. This is, as always, extremely, extremely beneficial. And again, that's why we've decided that this is a great platform for these things, because it's so complicated. Again, obviously, Mark is always available. Please reach out if you have any questions regarding IRA conversion strategies or any of the programs that we've talked about here. I appreciate your time today, Mark. This was awesome. I'm looking forward to the next one. So we will see you again on the next episode of the MBK Beat.
Looking forward to it. They're a lot of work, but I think they're worth it.
Oh, definitely. I'm looking forward to it. Go Bills.
Amen.